Good afternoon. So, this is the final session of an amazing conference here. Over 1,000 people, the law school, the business school, and the architectural school raised over $1 million in this last campaign. So everything is record-breaking, and I think we spoke to Andrea. I think we have an amazing venue here for the future. So we'll keep at it. Thank you very much. My name is Jay Masterman. I'm the current chair of the Masters in Real Estate and Urbanism Advisory Board. It's been a pleasure and a true honor to work in this capacity for the last 2 years. This conference can only happen with a community effort. I would like to thank the steering committee and everyone behind the scenes, and I'm sorry if I leave anybody out, in the following for this conference. So the School of Architecture, Dean CRE, Chuck Bowl, and the professors and the amazing board members that we have, I think 70 strong, and they're shaker movers in town, which is incredible. A very special thank you to the Emirate support team of Allison Freeland, Roxanne Vanderput, Natalie Bixby, and Connor James Adams for his great fundraising efforts and support. They've been great partners in this endeavor. We also thank our partners, the School of Business and the School of Law. It's been a great collaboration. I'm also very pleased to announce that Ava Jain, known to many in Miami, New York, and beyond, a really modern-day pioneer, will assume the chair for our Emirate Review for the next 2 years. Thank you, Ava, for all you do, and for all you do for the U. So, please take a moment to look around the room. It's astounding to see how much of our Impact Conference has grown from its humble beginnings in 2012. The other thing personally that I see here is all very major, iconic, active players in this town here over so many years that do so many great things for our community. So thank you for being here. Some of our original conference visionaries and longstanding advocates include Ambassador Chuck Cobb, is in front here, former chairman of the University Board of Trustees, as well as a few of our founding board members and past chairs, Robert Davis, Tony Goldman, Neeson Kasdan, Edgar Jones, Toby Cobb, and John Sundberg. Our themes in 2012 included global capital, reshaping urban spaces, and Miami as an epicenter. Who would have predicted the pace at which Miami has continued to remain in the forefront of those themes? With all of you as partners, we will remain dynamic in a rapidly changing environment and transformative influence on our industry and keep Miami as the center of the universe, the center of the real estate universe. This year marks our 11th annual conference. Our first Impact Conference was in 2012. It was held nearly completed 34th floor at 1450 Brickell with almost 300 in attendance. This year we have over 1,000 registered guests. From the very beginning, we have been fortunate to have our presenting sponsors, Kislak, the Witkoff Group, Douglas Elliman. This year we have over 100 corporate sponsors. Thank you to all those who have been with us since the beginning and to all those who have joined us over the years. It is your ongoing commitment of resources and enthusiasm that ensure the success of our academic programs year after year. The conference is hosted and organized by the combined efforts of the School of Architecture, Miami Herbert Business School, and the School of Law. Thank you to the Joint Conference Steering Committee for your vision and leadership, and a special thank you to Andrea Houston, Natalie Bixby, and dozens of people behind the scenes for another successful year that continues to exceed all expectations. The Emirate U program evolved from a Knight Foundation Fellowship and launched its inaugural graduating class in 2010. Since the beginning, it was designed to cultivate men and women fascinated and focused on the idea of thoughtful development and urban planning. These students benefit directly from the interaction and support of our advisory board, which is comprised of leaders who have a keen interest in student engagement, community development. I would like to recognize all of our current and past board members by asking you to please stand, if you will, just for a second. Thank you. Thanks to you, we are attracting greater interest and stronger applicants from ever before for our Emirate U program. You have helped us differentiate ourselves from our peers and compete to bring the best and brightest to South Florida. Now I am pleased to introduce Roger Morales, who joined KKR in 2011 as part of the founding team that formed the real estate platform. He is head of commercial real estate acquisitions and jointly responsible for all aspects of business, including acquisitions, portfolio management, and fundraising. He sits on KKR's real estate equity and credit investment committees and the equity portfolio management committee in the Americas. He is an alumnus in the University of Miami Business School and a member of the real estate, and a member of the Real Estate Advisory Board. And please, no further ado, please help me to welcome him to the stage.
All right. Well, I've got the fun task of introducing Ralph and Roy, and of course the tough task of keeping it short, given their resumes. We probably could be here for 5 minutes, but I'm going to try and keep it to the salient points. Ralph Rosenberg is the global head of KKR's real estate investment platform, which manages over $60 billion of debt and equity capital across the globe. He's chairman of the board of KKR Real Estate Finance Trust, chairman of the board of KKR Real Estate Select Trust, and a member of the board of KKR Realty Japan Management. Prior to joining KKR, he was a partner at Eaton Park Capital Management and also managed his own firm, which was called R6 Capital Management. Previously, Ralph was a partner at Goldman Sachs, where he started his career in 1986. He holds an undergraduate degree from Brown, where he graduated magna cum laude. He holds an MBA from Stanford. Ralph is a global and U.S. trustee of ULI, the governor of the ULI Foundation, former chair of the board of PREA, and a former member of the board of the PREA Foundation. On a personal note, I've had the immensely good fortune of working with Ralph and for Ralph since 2007, exactly 7 years after graduating from the University of Miami, and to be part of the team of 6 that started KKR's real estate business in 2011. And I'm proud to say that under Ralph's leadership, we're now 160 people across the globe. Roy March is the Chief Executive Officer of Eastdil Secured, the leading global real estate investment banking firm. Roy's career at Eastdil spans over 45 years and includes some of the most transformative transactions recorded in the real estate markets across the world. For context, under Roy's leadership, Eastdil transacts on over $200 billion per year, and has been involved in over 2.8 trillion transactions since 2007. For anybody doing the math, that covers only 16 years of Roy's career. Roy serves on various industry, corporate, and community boards in addition to philanthropic work. He's a trustee and a member of the global board of ULI, past chairman of the advisory board of the Sam Zell Robert Lurie Real Estate Center. He's on the board of the Real Estate Roundtable, and he's formerly on the board of PREA. And now you know how hard it was to keep that short, given all the accomplishments. Thank you, Ralph and Roy, for doing this. It's incredible that we get to have you here. And Roy, I will turn it over to you.
Great. Well, thank you. As you can tell, I couldn't get a job anywhere else. One look at me, and you know that I either had to stick in one place or I'd be unemployed. So 45 years later, here I am. It's good to see you. What you forgot to say is he's an all-around good dude, and I've known him for a long, long time. A, B, he, along with a great team that he put together, built the real estate business at KKR. And they've had fits and starts along the way, but you really put it in a position that KKR as a firm deserved. And we're all fortunate that we have a private equity firm like KKR that has someone who's leading the real estate charge with you. So I just 15 basis points inside of what, anyway. But I think that just to kind of start with the broad base here, which is kind of your views as to, and I'll share some of ours as well, but your views as to how you see kind of the global economy. You see it across literally the globe itself, and where it's going, what places it's going, and ultimately how that's impacting the people in this room relative to the real estate business.
Sure. First of all, it's great to be here, and my compliments of Roy are reciprocal, so it's great to be with you on the stage. I'll share a couple of very broad observations that really are informed by not only the $200+ billion of real estate that we have looked through information on all over the world, but probably more importantly for this audience, the look-through takeaways that we get from all of our portfolio companies in our private equity business and all of the companies that we lend to in our credit businesses. So I'd make the following observations. We definitely feel like the world is slightly better today than it was in Q4. And that's largely driven by the fact that we think the deep recession risk in the US and in Europe is, for the most part, off the table. In particular, while we see cost inflation still creeping into our portfolio companies, we're starting to see that plateau, and we're starting to see the early green shoots of costs coming down, which is sort of what you're seeing Chairman Powell refer to in his comments. But we are seeing that in our portfolio companies in Europe and the United States. I would also make the obvious observation that energy costs have come down, largely blessed by mild winters for the most part in the United States and more importantly in Western Europe. And that translates into better economic checks and balances for corporations that manufacture in Europe. Lastly, I would say, and we could talk a lot more about this, but just to keep it crisp, that Asia, for the most part, had been isolated from this Ukraine, Russia-driven reset of the Western economies and really had functioned relatively resiliently over the last several years, even with China in a lockdown. And now with China coming out of COVID, you're starting to see a very aggressive move towards an acceleration of GDP in Asia, which is obviously important for the real estate community, not only in Asia, but will also help to continue to restart the global economy. So that's sort of a high-level overview to say that we think that it's sort of what we call, it's time to move from like a walk to a slight jog in terms of investing, market-facing activity, but we're nowhere close to like what we would call like a let's go, green light, risk on attitude.
Flashing yellow.
Yeah, flashing yellow sounds good. How about, what do you think?
Well, I think that, again, we're just a small little company trying to transfer money with people who've got a great sense of humor and a lot of cash. But the bottom line is that we see it in the same context, which is that we're looking at where inflation is and where it should or shouldn't be. And if you look at like the TIPS, for example, the Treasury inflation protected securities, and you look at how they're being priced today, both the 2-year and the 10-year, they're like at 2.3 and 2.4%. So the market is betting on, predicting, they're not always right, but in that market, it's basis points. It's not full points, if you will. It's suggesting that in 2 years that inflation will be under control in the 2.3 to 2.4% range, as well as the long term in terms of the 10-year. So that's an indicator. It's one of many things that we look at around the world. As you point out, that we got this kind of hyper jolt, if you will, as a result of the Ukrainian invasion and ultimately its impact not only on oil and energy, but all of the derivative elements of it, which people don't always think about, but it's everything from fertilizer and food and all the rest that then kind of translates through. And we were tested a bit in terms of some of our geopolitical policies, trying to get our friends in Riyadh to maybe cooperate with producing more oil, and instead they gave us a one-fingered salute and said, not only that, we're not going to increase our production, we're going to pull it back. Just to kind of level set, if you will, the dialogue around, who's in control at this moment in time in terms of the discussion. So, and we've got this Fed, who, by all accounts, is the leader, if you will, of the global banks, if you will, basically trying very, very hard to stomp on inflation. And at the end of the day, we've had, and it's gone into the risk side of the world, but we've had the fastest rise in discount rates that we've had since the early 80s. And even if you look at the early 80s, it was over some period of time. We've had 500 basis points that have been pushed through literally in 12 months, and some more yet to come. And I think that we've suffered from a little bit too much visibility around the process that they're going through, and too much equivocation. I think that most people would like them to step on it harder, faster, so that we could adjust, survive, adapt, and advance around it all. But they are where they are, and the best guess these days is that they're going to go ahead with 2 more 25 basis point bumps and be in that 5% range, somewhere in or around that 5% range. So that jolt to the system did 2 things. One, the cost of capital went up substantially as a base rate, but it also put risk into the system, and that risk translated into spreads. The best indication, at least around the safest rate, if you will, investment-grade corporates went from 60 to 111. They're now, interestingly enough, on the corporate side, back down to in the high 60s, low 70s, relative to that. So, I mean, it's beginning to recover as the world looks out there and feels like it's maybe a little bit more stable. And as it relates to the impact of that, that's in and of itself a lot. But then we've also had the bank regulators step in, and there's this what's called CRE, which is in essence a test of a bank's Tier 1 capital at the end of the day, and its ability to be able to function without failure. And this is a Dodd-Frank thing that came about. And they stepped in, and they didn't want to be left behind in the parade, if you will. So they stepped in, and they've done some pretty severe put some pretty severe reserve requirements on. The lack of a buyback and dividend control has been part of all of that, but it's really stepped on the liquidity significantly. And just to give you an example, there are these subscription lines that people take out when they have a fund that they ultimately use to fund initially a transaction, and then ultimately either take it through financing or what have you, and then fill it back with whatever those subscription agreements are. And these are subscription agreements coming from endowments, pension funds, sovereign wealth funds, and the like. And for the first time that I can recall in my short 45-year career, they actually asked these banks to take reserves on those subscription lines, which curtailed, in essence, the ability for the banks to be able to lend on anything. And so that was another little piece of the puzzle that was squeezing more liquidity out of the system. And then the third piece was quantitative tightening, right, which is the burn off of $95 billion a month, which our best guess is that's anywhere from 50 to 70 basis points of incremental cost in the market as a result of supply and demand. And so those 3 things, and the Fed's push on the front end and their influence around all the rest of it, and the political risk around all of it, have really cramped the liquidity at the end of the day. When it's all said and done, those are the 3 things that we're watching most closely, which is, and any one of them probably isn't a tell. 2 of the 3 might give you something like a flashing yellow light, but it might take all 3. And we think the third, quantitative tightening, is the easiest thing for them to fix and monetize and kick the can down the road. But these reserves, and they're coming up in June, will be a tale of the tape. Now, they're earning a lot of money, these money center banks right now, so everybody believes and feels that they'll get there in terms of their Tier 1 capital fairly easily. It's just a question of what they're going to do in terms of incremental restrictions around the reserves themselves, just to kind of manage it through while the Fed's doing their thing, if you will. So That's the big question mark out there, which is not, we don't think it's if, it's when. And every time there's an equivocation out of the Fed or, saying things that are contradictory to what the statements are that come out from time to time from a governor or two, it continues to put a little bit of uncertainty in the marketplace for sure. And you talk about fourth quarter, I termed it as FOMAM, which is not the FOMO is obviously the fear of missing out. FOMAM is the fear of making a mistake, right? And nobody was going to get rewarded in the fourth quarter of 2022 to do anything. It was too late to sort of do anything that was going to influence their incentive comp, if you will, and it was too late to preserve a job if they had already made those mistakes early on. So the fourth quarter was a dead quarter, if you will, and just to put it in the context of what it means to all of us, we're down 21% year over year from 22, which was a record year of $380 billion worth of transactions, over $25 billion. But the tail of the tape was that we were down 54% in the second half of the year, 65% in terms of transaction volume in the equity markets in the fourth quarter alone. So we watched this huge pipeline, kind of shrink pretty dramatically. What we're seeing is, again, kind of a wait and see, if you will, in the first couple weeks of the year. But really, over the last 3 weeks or 4 weeks, we've seen a tremendous amount of activity. Bidding lists are expanding. I mean, we didn't have lists. We had a party of one oftentimes. It's juggling if you do it fast enough. But at the end of the day, we're beginning to see people come back, particularly on an all-cash basis, and financing's, an issue. I think it's going to be great for the non-bank lenders in the world. Thank you very much. We got to get you to the point so we can make you the mayor of Miami before it's over. But at the end of the day, we're beginning to see that. And then the other side of it is, so you've got the trophy, if you will, and then you've got the trauma that's out there. So if you look at the banks right now, the volume, and we're in the trophy and trauma business, if you will. Secured Capital was the largest vendor to the RTC and we thought 2006 when we acquired Secured Capital that was going to be an opportunity for us as we saw cracks in the system in 2006. We were directionally right. Specifically, we were wrong in terms of the government not stepping in, but all the mezz holders who we had placed all that debt with were available and open for business. But that is the sector that we're seeing the most activity right now. And to give you a sense, the BOV activity in the last 3 weeks has gone from $5 billion to $14 billion to $18 billion in the last week. Okay, and these are 80% of it is in the office space, which we can talk a little bit more about in terms of conviction and all the rest. But the point I guess I would leave you with, at least for this part of the subject matter, is that there's a tremendous amount of capital in the world. The sovereign wealth funds are particularly petrodollars and things that are dollar denominated in the Middle East. And I just got back from a tour of that last week. With some of my colleagues from that part of the world, just minting money. They're actually starting to take that money and put it to work. It's going to be in the credit space first, because on a relative value basis, that's where they see the opportunity. They've already got their commitments to the opportunity funds and the like. And then you look at Asia, and yes, it is compartmentalized, but if you look at the draw to what we call Switzerland, aka Singapore, of the East, there has been over 600 family offices that have relocated from China and Hong Kong into Singapore. And we think that's a platform setup, and there's good juju between the Singaporeans and the Chinese. So nobody does anything in that part of the world without at least a tacit approval of all of it. But that capital, and if you look at where GIC has played in this period of time, just closed on their behalf a $15 billion transaction that they would have done all cash. So their capacity to be able to do things is remarkable. There's a lot of capital there. There's a lot of capital at NBIM, and they're changing some of their strategies. we're suffering right now from what we'll call the denominator effect here in the U.S. and Canada somewhat. But that's sort of the liquidity side of it. If you now look at the demand side of it and the supply side of it, very little overbuilding. You know, there's exceptions all around the world, but very little overbuilding per se. Strong rental market, strong demand market, particularly in 3 or 4 or 5 of the major food groups. In particular logistics, which depending on what avenue you want to play in that could be anywhere from an 18 to 30% mark to market with that kind of thing. So that's obviously very, very attractive. On the multifamily side, it's not the double-digit loss to lease that we were seeing in the middle of last year, but it's high single digits, particularly in the Sun Belt. You've got the data center business, which has changed substantially. Again, the inability to be able to to build those big projects, given the financing markets and the demand side that is growing. It's finally a business that's going to be indexed, we think, and there's going to be opportunities in that perhaps. But the demand side seems to be very strong. And then the hospitality business, and then everything in Miami at the end of the day. Good news for all of us. And it seems to be a sustainable dynamic. Just as we were talking over dinner last night, that was kind of the phrase that kind of came to me, that Miami had been episodic in terms of the surges that have occurred over the decades. This feels like a sustainable dynamic for the long term. And it's not just the things that are going on with governance and taxes and the issues with health and safety that go on in a lot of these other places. But it seems like that's it. And so we've got a pretty strong supply and demand dynamic. And at the end of the day, that's the source of which we all make our pro formas, if you will. And then the cost of capital is the outstanding thing. So we don't have a lot of what I'll call endemic issues, except for office, and we'll call it the commodity office, that can't be transformed into something with a different use, which we'll talk a little bit more about. So that's kind of our worldview of we're a collector of data and information.
Sure. Well, I mean, when I listen to how you describe it, it makes sort of total sense, because you're going to start seeing capital come back into these markets, both from the lender's perspective and the equity participants' perspective, when there's a feeling of stability with respect to the medium-term GDP outlook, wherever you are in the world. And to your reference about December, there was so much uncertainty as to what the global economy was going to look like that everybody just stopped.
Yep.
And now that we're seeing these green shoots, albeit they're just sprouts, people are starting to dip their toe back into the water. And notwithstanding the fact, as you point out, that the Fed and the government are doing things to mute liquidity, they're having the effect that they want to have, which is to slow down the economy, but without putting it into recession. And therefore, like, this soft landing is now more of a base case that people in our industry can underwrite off of. And now the game is going to be, where can we all make real estate investments where we really believe that the underlying growth fundamentals are going to exceed whatever your expectations are in inflation. Because the game of that we've basically been playing for the last 40 years of, underwrite growth, and if you missed, it didn't really matter that much because you got the benefit of cap rate compression and yields coming down, and that could hide misses in pro forma underwritings on fundamentals. And now our industry has to sort of go back to the old days of what the industry was really set up to do, which is to outpace inflation with respect to growth exceeding CPI in the underlying asset market.
Yeah. Well, and I think that there's, the hangover, and what we had, let's face it, in the early, in 21 coming out of everything, in early 22 was, like dropping ecstasy into the punch bowl, right, with a little bit of white lightning to go with it. Those who know me know.
I'm not familiar with that personally, but...
But the bottom line is that we had incredibly low generational interest rates, right, and spreads to go with it. Usually when rates come down, spreads go up, spreads stayed down, rates came down. And then we had these high single-digit, double-digit kinds of growth rates at the same time. And I mean, it was just, I've never seen anything like it in my, again, short 45-year career. And so there's a little bit of that hangover as well, where people bought into that, and they're still probably there as it relates to where the growth rate anticipation was, because nobody underwrote 17% forever. But the one thing that they did do, which we'll talk a little bit more about here, which is they did a lot of floating rate debt. And that floating rate debt came with caps associated with, whether it was a 2-year or a 3-year cap. One of the things we're looking at is not just maturity schedules. There's $160 billion of office buildings maturing between 2023 and 2025, and over $300 billion through 2029, excuse me. So you look at the maturity schedule and you go, wow, that's pretty, tough. But then you look at what's going on with these caps. These caps have gone up literally 16 times on the 2-year and close to 8 times on the 3-year. That's real money. That's 2 points, right? That's 2 points on a deal that they financed on a floating rate basis. Now, whether they can get the banks to in essence, take the cash flow instead of using the caps and the new cap rate, not the cap rate, but the new cap to, in essence, lower their exposure, we'll see. But that's another significant dynamic that's going on, because literally 80% of the $80 billion a year plus that we financed during that period of time were floating rate. And
100%. I mean, listen, you don't have to be probably older than a 7th grader to understand the math of what Roy just described.
My intelligence.
I mean, you can't have your cost of financing double in basically 14 months without a massive deleveraging of our whole industry. And it takes a lot of growth to compensate for unlevered discount rates widening 100 basis points and the cost of capital on the credit side doubling. So we're going to watch this deleveraging of our industry. Some of it's going to be like the easy regular way, which is sponsors paying down debt, or better than that, growth getting to a point where with the new normal of NOI, you can refinance out your liabilities. Or we're going to see it the hard way, which is these facilities are going to expire and sponsors are going to be unwilling to pay for the extension of their call option, and lenders are going to basically refuse to extend and ignore the problem and offer that option for free, in my opinion.
Yeah.
And then you're going to see like a unwind of some of these problematic asset classes in a potentially very aggressive manner, with short sales and lenders really aggressively forcing the resolution of these capital structures through sales and effectively taking losses. Yeah. So, I mean, you're gonna be in the center of this whole universe, but
as I said last night, it's why God created Eastdil Secured. It's time. At the end of the day, no, it's strategic asset resolutions is what we call it, solutions and resolutions. But the truth of the matter is it feels like it's going to be somewhere between the hard way and the easy way. And the reason I say that is that with rates where they were last time around, an owner could bet on growth with a low interest rate environment. Carrying costs today, the notion of them putting more money up to do something is not going to be there. Right. And that's an opportunity, and we'll talk about where some of these opportunities might lie, whether it's in the preferred markets, convertible preferreds, participating debt. Somebody's going to get something more than a debt return for participating in, what would be a high quality piece of paper in the capital structure. But the banks don't really want it back either. And so there's going to, we see it, and we're seeing it right now, is we're having a conversation with the banks and the borrowers at the same time for a mutual resolution. And no one's throwing keys back. People are just sliding them across the table and saying, do you want it? No, I don't want it. Yeah, well, nobody really wants the keys. And so the answer is to be in a position to be able to resolve that with a real transaction, right? And so it's going to be somewhere between the hard way and the easy way.
What I actually think is going to happen is that it's probably not going to be the money center banks that facilitate this massive unwind. It's going to be the shadow banking community, of which there are now 120 in the United States.
You make it sound nefarious. These are really fine institutional
I'm one of them.
owners.
Full disclosure, I'm one of them.
They're the saviors of this.
Exactly. Well, we're going to find out
Yeah.
because that whole industry is effectively financed sometimes with non-mark-to-market back leverage, but more times than not with the effect of repo mark-to-market facilities provided by the commercial banks that are not set up to hold non-performing loans.
Right.
And any of these structures that are funded with closed-end fund capital are going to face a day, in my opinion, a day of reckoning around where the capital is going to come from to pull a non-performing loan off of a commingled credit line that's held by one of the banks.
Right.
And I believe that dynamic will cause a need for short selling to try to resolve these assets, because anybody who invested in a closed-end credit fund did so because they ironically thought they were doing something conservative, and they thought that they were getting cash flow. And the day that an LP gets a call from their GP and the GP says, our cash flow is getting trapped and we don't have capital to deleverage that line, I think you're going to see this sort of play out very quickly.
Yeah.
I don't think it's going to be because Bank of America is going to call up a borrower in Austin and say, you got to pay me back tomorrow. I think it's going to be caused by this derivative knock-on effect in my view.
Agreed. So as it relates to, as we've kind of described the profile of the world, and specifically the liquidity markets and the fundamentals in real estate, where do you have strong conviction around product type and capital stack? You have a variety, maybe describe quickly, because you have a big variety of capital sleeves that you can put to work, from insurance to opportunistic.
Sure. So just 2 seconds to frame the answer. We run $64 billion. About half of that's in credit, half of it's in equity. We provide senior secured first mortgages with insurance company capital that we control, and then we have opportunistic capital, and then we have everything in between, and we run a global business. So everything we do, whether or not we're a lender or an equity investor, maps back to one of 3 types of themes. One theme is around demographic migration patterns, the movement to Miami, the movement to the Sun Belt, the movement from agrarian China into Beijing and Shanghai, the aging population in the US, those types of trends. The second bucket of themes is around how corporates either produce or distribute goods. So what themes you can imagine would impact, or what things would impact those themes? The widening the Panama Canal and the deep water ports in the Eastern Seaboard, onshoring in both Europe and the United States to reduce dependence on China, examples. And the third bucket of themes is around how consumers change their habits around spending or behavior. A couple examples of that: some people work from home in the United States. Some people prefer to domestically travel because they're scared of COVID. The opening up of consumer travel coming out of China reopening, those types of themes. So I frame all that to now give you like a substantive answer to your question. You guys could all sort of think through like what property types in what markets are reflective of those themes, where there is tangible evidence around the sustainability of demand for occupancy and therefore rental growth in markets where there's supply-demand balance. So we still like multifamily and single-family for rent in the United States, largely because we think the barriers to entry are high with construction costs. Even though they've come down, they're still prohibitive. And of course, the ability to access construction financing is very prohibitive. We like industrial in many, many markets around the world. We believe in this bifurcation of the office sector that you referenced in the United States in particular, but I would also make the observation that in markets outside of the United States, there was not the flex work mentality in Europe in terms of how the governments provided stimulus to the populations. They did not provide that directly to the individuals. They provided that to the companies who were allowed to subsidize their payrolls with stimulus. And so in Europe, basically everybody kept working. So we like some of the office markets in Western Europe, for example, and in particular the office markets in Asia, largely because working from home culturally was never accepted, and domestic residences in most Asian economies are quite small. The resilience of some of those office markets is pretty strong, and so we like some of those markets as well.
Great. How about hospitality?
Yeah, we're big believers in the recovery of the hospitality market. We're actually, I would say, significantly underweight the sector. I'd like to get more exposure in most every market. Where we're most cautious about hospitality are in the blue cities in the United States, because the cost of labor is prohibitive. It's very difficult to renegotiate labor contracts. While this is a very successful conference in a major market, I think there is, in my view, a paradigm shift in terms of how well-attended conferences are going to be once we all, have experienced a couple years of going back to conferences. And so, short answer, Roy, I think hospitality is super interesting, largely because the barriers to entry are quite high with respect to new construction. But I'm more interested in limited service in the United States and gateway city type exposure in European and Asian countries.
And resorts, probably a little bit?
We're not really resort players. Maybe we're all a product of our own experiences. And, once you've had a couple of bad experiences, you typically don't rinse and repeat. And, the Caribbean's been sort of off the table in my mind, forever for reason,
Other than your own personal travel.
Well, Roy and I spent a lot of time in St. Bart's together, but, listen, just weather risk is a simple thing that I worry about. So resort activity is not really up for that.
Got it. So you've been at this a long time, and I have too. What's different about this in your mind in terms of how things kind of roll through the system? And you referenced part of that experience that you had is that you feel like this is going to kind of clear maybe a little bit more quickly across some of the sectors, most of the sectors, maybe not all.
Listen, I think the biggest difference is that when I look back, I started my career in 1986, and when you look at like the sophistication of our industry today versus when you and I started, you would run models and you'd plug in 3 or 4 or 5% growth. You didn't really spend much time thinking about the relationship between real estate cap rates and BAA credit spreads and the risk-free rate and real rates of interest and investment grade credit, because back then the industry was not an institutional industry.
Right.
And fast forward to where we are now, the good news for all of us is that it is an institutionally accepted asset class, which keeps all of us basically employed. But the bad news is that you cannot hide.
Right.
You have to price real estate risk relative to all these other risk assets, and you have to really think about how you're really creating value over the medium to long term with respect to what I referenced earlier around sustainable, predictable earnings growth that exceeds inflation, and do it in a construct where you're not overpaying for that opportunity. So like, how do you think about unlevered discount rates today? How do you think about what kind of a cap rate you're willing to underwrite in a model? Today, to me, that's all about these relationships that I mentioned between real estate and other risk assets, and where you think growth is going to be relative to these risk-free benchmarks. And that is a game that I think most people have not yet learned how to play, because none of us have had, including me, we haven't had to play that game because we got the free lunch of low rates and we got the benefit of these incredible tailwinds that cap rates kept compressing and spreads kept compressing, and you could hide in your capital structures behind these fundamental realities that you have to really focus on today. So to me, it is a new game. And I think we're going to see, including, we're going to test ourselves at KKR, how good we all are at playing a new game.
Yeah. Well, let me probe that a little bit, because it gets to one of the things that I think would be worthwhile talking about, and that is culture, right? And you talked a little bit about the fact that you've got all these portfolio companies across the firm itself that feed in a lot of data, trends, and orientation. And ultimately, this is a business that was pretty opaque, as you point out, and today it's flat like everything else, and data and information is a little bit more relevant, and where you get it is a lot more relevant. Talk a little bit about, if you don't mind, because I think it'd be useful, particularly for some of the students here, to talk about the KKR culture, because it is unique in private equity in many respects. It's not the rip your face off model that some deploy. And private equity can be partnership or predator. And obviously KKR has been around amongst the longest of all of them. And why and how has it been successful, and how do you then, from a cultural perspective, cross over?
Sure. And by the way, I think our cultures are quite similar between Eastdil and KKR with respect to really promoting collaboration and information sharing and credit sharing, and really trying to create the best outcomes for your clients and my LPs in a we, not I culture. But to dig down quickly into like the KKR culture, a couple of golden rules. Number one, nobody owns a piece of their own business. So it is a one firm P&L, and that promotes collaboration almost by definition, because we all share in the success of the common good of the whole firm. That translates into collaboration being a normal activity across business units within the firm. And for example, we have a couple hundred literally portfolio companies around the world that I referenced very briefly before. Twice a year, we do surveys of those companies to really learn about how they are manufacturing and distributing whatever they do, whatever they produce, how they're treating their own workforce. We employ about 2.5 million people in all these portfolio companies. So there's a relationship that we're seeing firsthand between employers and employees. And we have the ability to interpret that information, and as George Roberts likes to say, to skate to where the puck is going. And so that culture of connecting the dots across different parts of the firm, I think, gives us a slight edge relative to a standalone real estate investor or lender. I would also comment that in our business, because we do have a credit and equity business, I think that is a very, very important and powerful set of tools that we access in terms of how we source deal flow, how we underwrite deal flow, how we price risk, most importantly, how we work with sponsors and intermediaries like you guys to be relevant solution providers to the capital markets. And that collaboration, even within my own business, is real, largely because just like the firm is paid off of one P&L, our global real estate business is paid off of one P&L and one global comp pool. And therefore, we're all in it together. And I think that, and by the way, probably most importantly, we are an in-the-office firm.
Amen.
So everybody, when somebody in an interview says, "What's your flex work policy?" our response is, "This is not the place for you."
Yeah.
And we mean that out of a sincere belief that being together really creates better outcomes. And Henry Kravis was interviewed, I can't remember on which media outlet, and somebody asked him the question, what's your work from home policy? And he said, our policy is we work from work. Right. And I think that is important to our culture and allows us to share this information and migrate this information around the world. And so, last comment on this, what we're seeing in the industrial complex in the US, in the real estate space, we have people who are doing industrial in China and in Australia and in Korea and in the Netherlands, and we're sharing all these inputs as to what's happening from a capital market perspective and a fundamental perspective that might inform colleagues around the globe as to how to either put the foot on the gas pedal or put the foot on the brake. And a lot of the things that a lot of the decisions we make that are the most important decisions are things that we don't do as opposed to the things we do. Yeah. And so, it's all about culture.
Yeah. Well, I agree, and if I might just, there are a lot of similarities, and our founder, Ben Lambert, who literally invented the real estate investment banking business back in now 57 years ago, his whole perspective was the world was going from a local tenant market, developer market, and ultimately capital market to regional, national, and international. They happened to have the first deal that was ever an institutional joint venture, which happened to be $150 million financing, joint venture financing on behalf of Rockefeller, Trammell Crow, one Embarcadero Center, and the Hyatt Regency there. That was the first time Prudential actually invested in a joint venture. It was 1980. And he foresaw this, but he thought that the only way that you could ultimately grow like that was to not have more people than you had integration and collaboration and the like. So we literally, and we brought in people like Stanley McChrystal to help us develop our communication and cultural things, and he ran the Joint Special Operations Command. The most important day important hour of their day was sharing intelligence across the entirety of the world as they were pursuing the bad guys, if you will. And so from our standpoint, literally that hour every week that we get together, it's literally everybody across the world sharing important information of what's going on in capital flows, demand flows, and the like, and you can spot these things, these characteristics that will translate into something that will be there down the road, around the corner, that you can get in front of. And, our whole mission statement is to, in essence, develop, creative and actionable ideas that are valuable to people. And that keeps you from having to compete and for the most part for that. And it's a collegial and one P&L across the entire firm that at the end of the year we sit around and invest in the people, and they're basically invested in based on how well our clients did. And it's a client-centric thing. If our clients win, the firm wins. If the firm wins, the team wins. If the team wins, then the individuals win. And it's about a total collaboration. So we're able to do $250 billion a year with about 350 professionals because of that sharing and that leverage. And in fact, I would say that the law of diminishing returns is if you get too big and you start losing that ability to be able to share and collaborate, you lose the culture and you lose the benefit of all of that at the end of the day. Great. So I don't know, how much time where are we in time?
We have about 4 minutes.
Okay. So in 4 minutes, can you give the students here some insights and maybe some recommendations as to how they might spend the rest of their time at the U?
Okay, wow.
in 4 minutes.
I'll give you the same advice I give my own kids, which is you have to look at in this context, the real estate industry, and think about all the different parts of the industry. It's obviously a very big industry, and it ranges from being developers to being capital allocators to being intermediaries and solution providers, and then all the experts that sit on that continuum. And one thing I always say to anybody who asks is, like, I'm not really, I know it sounds weird, in the real estate business. I've never gone to a town planning meeting. I've never negotiated a general contract for construction. I've never, done all the things that you do to literally create a real estate asset. I'm really a capital allocator. And so I would challenge everybody while you're still in school to, like, really deconstruct the whole industry and ask yourself, what about the industry excites you? Is it being a creative visionary in terms of creating the physical footprint? Is it looking at financial markets and solving financial problems? And if you map the industry along these lines, I think you'll have a much better sense as to what excites you about the industry, and then how to find a career opportunity in the industry. So that's my real estate advice. And then my personal advice is, I really meant what I said earlier, that you really don't have to have more than a 7th grade math education to do what any of us do. And the whole industry, in my opinion, is about like and trust partnerships, EQ, and how you interact with people to problem solve and to create outcomes. And so I would really focus on developing, and I still am developing mine, our interpersonal skills and relationship building. And then lastly, there's no game in my mind where you can do something sort of part-time. You got to be all in. It's a competitive world. It's a competitive industry. You got to decide if you want to, play in a competitive sport, and if you do, it's sort of a 24/7 game. And I analogize it to, like, being an emergency room doctor, and the ability to triage your career and your life and your work-life balance, so that you really know when it's mission critical that you need to be in the office or be in the ER. And when it's a toothache that can wait until Tuesday, then you can, enjoy your weekend. But if it's a competitive bid and you got to put it in on Monday, and everybody's got to be in the office all weekend, you got to be up for that. And that's not just with respect to our industry. That's, in my opinion, with respect to life. And so that would be my last piece of advice, is, like, I'm all up for having fun and working hard and playing hard, but if you want to be in a competitive industry, you got to be ready to play hard when necessary.
Yeah, great.
What are your thoughts, Roy?
Yeah, you're the guy who seems to be able to have this incredible lifestyle. And
Well, I mean, my perspective is that, in our industry, too many people, particularly in the capital markets, focus on the what and the how. And I think that you need to focus on the why. What is that fundamental demand driver? And that's kind of a human anthropology thing, the psychology of it all, and what is it that motivates people to want to live, work, play, because that fundamentally is how we end up with, that V that we all underwrite relative value to, and how you then ultimately price that relative value in a financial model and on a capital stack. And it's easy for me to say that because, the art and science of our industry is just magnificent in terms of the imagination, creativity. And if you have a 7th grade IQ, like mine, you appreciate the EQ, and hopefully you can develop the SQ as part of all that as you're here. And so encourage you on the liberal arts side as much as you can, particularly in these final moments of your college career, because it's going to teach you more about what you're going to do in the real estate business than anything you might be taught on the science side. So,
With that, I would like to thank our last session,
Thank
our
you.
last panelist. Thank you.
thank you, Betty. That was fun.